It's May at Markets with May, and right now I'm going to cover SoFi Technologies. And this is kind of a thank you for some of the folks that watched my last episode and have subsequently been supporting me. I'll try to do as many as I can in a row of the companies that I know people care about, but I also care about it. SoFi had an amazing quarter, but nonetheless, it's down like a champ today at 12, down 12. I'm going to go through the financials and then talk about how I'm going to play it. I did have a position going into the quarter. I had strangles going into the quarter. And, right now I have nothing on it, full disclosure. And then obviously I have to say the past performance is not indicative of future returns. That's kind of the thing. What I think I'll most likely do is I will let the thing settle a bit and then consider going long because this was quite an outstanding quarter. All right, let's go into the deck and keep this on the shorter side. Let's see. I want this one. Yeah. Okay. So, there's going to be a lot of folks that come out and talk about this stock, but I think what sometimes makes it hard with any financials, and especially because I think that the news in general has done a terrible job covering the financials. Sorry. I know that's a lot of hate on a lot of people, but these financials should be something that anyone can read so they can assess. Because it's very confusing to go to through bank financials, you get these really crazy reports off of the media, and then the bankers, if you don't catch the clip where the actual CEO is talking, it can be very difficult. This is SoFi's income statement, and it crushed it. Okay, we're talking about revenue up 218%, if we're honest. But because the way that banks go, you don't read revenue that way. Okay, what you do is you read it what would be the equivalent of gross if you were to in any other business. But you take interest income, which is their revenue. That's the interest rate they charged you, and then you remove the cost of capital. And when you do that, you still end up net of expenses, net of that expense, up 151% on the interest portion of their business. The second business that they have is fee-based business, and that's up 43%. Okay. Now you get to top line. So you end up with this top line growth that's phenomenal. Okay. And that's total net revenue there. For 472 versus 330. There's nothing in finance that's making anything like this. And if you're worried that they're doing some funny business, they're not. I'll show you exactly why they did it. As far as costs go, sales and marketing was up 26%. They are actually able to dial that back now versus previous quarters. So you're growing like crazy like this on the top line, and you only increase sales and marketing a touch. R&D up 44%. R&D for them, which they're calling tech and product development, that's going to be refortifying and continuing to build up your systems, your interface. That is also a function of the sheer raw number of new products that they're developing and offering to their existing client base. And then it's also new product development and what it means to then get that launched and out to customers and clients. So this was a clean income statement. Okay. And now let's go to the balance sheet. The balance sheet looks fantastic as well. Just reading it so that there's not confusion, because I'm sure everybody's like, but it's a financial company. So absolutely it has to be like, First Republic or Silicon Valley Bank. No, it doesn't. Okay. Finance is this big overarching thing of which there's a lot of many small things. Even within banking, there's a lot of small bank stuff in there. So when we look at this, the key thing that you want to look at and understand is, especially if you're worried that it's like a Silicon Valley Bank or First Republic, is how diversified is their funding source? We'll go through that. The answer is pretty diversified for what it is, but also the mix of what it is very interesting. So we've got about $4 billion in cash and cash equivalents, which, by the way, is up $1 billion over the year. So unlike other financial companies, you're seeing a decline in cash balance for the ones that are truly weak, of which, by the way, First Republic actually increased the cash buffer. Here, you're getting a growing business plus growing cash on top of it. So $4 billion worth of cash. Deposits increased by 37%, but we saw loans only increase by 15%. So It's a cleaner balance sheet. Okay. Just in case that's confusing, it takes a little bit of effort to understand it, but it just has to do with the fact that we aren't really, I mean, even though deposits are becoming a bigger portion, they're truly buffered even in outflows for the amount of loans that are being written. Okay. Nothing wrong with this balance sheet. And then I got to give them credit. They go further into the mix of it. Okay. So what exactly is that loan book? So if we go over here, you can see loans, what am I doing here? Here we go. Yeah. Okay. So loans, here's the balance sheet. Loans held for sale at fair value up just a touch. That's what I'm talking about, up 15%. Okay. What's that mix? Because those are held for sale. That mix is actually great. Here's the mix, 65% personal loans. We talked about the fact on the last time that I presented this, that the interest rate that you get, that margin, that net interest margin is much higher on student loans. Kind of makes sense that that would be the case given that they're offering such a juicy interest rate on deposits right now of 4.5%. You know what I mean? So that personal loan piece is important. 25% student loan. We're still waiting for the moratorium situation to resolve itself, and 10% other. The other is actually mostly credit card loans. So the receivables off your charge card. You guys all know that your credit card charges you a huge interest rate. So let's not be confused. That's not bad. Those aren't bad loans. All right. And then throughout the entire thing, we're seeing very high FICO scores. Let me show you what he presented last quarter on those FICO scores. He presented, this is December 2022. They didn't do this breakout. This was from the K. This is just a quarterly report, so they didn't do the full breakout, but they did verbalize these words on the call. So you're seeing at last quarter, weighted average FICO was 747. That is a very strong FICO score, especially given the age demographic of what he has versus like any other bank. Okay, so 747. This time he was saying that the FICO score is over 760 on a weighted average basis. So it actually got to be a cleaner set of loans, not a worse. Okay, and then again, this was his interest rate in December. We know that rates have increased since then, so that's only gotten juicier, if you will. So nothing wrong with that whatsoever. And then let's go back to the mix, funding mix. Here we go. You've got 10 billion in deposits down here, and then 6.1 billion in debt financing. What does that mean? Debt financing is warehouse financing. So they did a huge loan and a bunch of folks put money in it, and it's just there for them to fill up with more loans. Then there's securitizations, which is them building a particular book to then sell it out to the market in a particular way. But 36% comes from that type of debt financing, let's call it. 10 billion comes from the deposits. And then if you look at the mix of it, you can see where it sits. This thing is going to mostly be focused on personal loan financing, both credit card receivables and me going to get a loan and trying to refi other little baby loans all together into a lower interest rate. So that's what's happening at SoFi. Let's see, anything else? Other little notes from the call. He's getting close to a 20% margin. That's so high, you guys. Oh yeah, I want to show this. This is his return on common equity. And this is despite the fact that this company is still growing into getting bigger return on capital. So they do get, they're down here on economy of scale. They're not like way at the top like a JP Morgan that is done with economy of scale. There's no additional increase to come. He's getting a 23% return on tangible equity. That's as high as PNC, which did not expect to get that. And we could see that continue to do really well. But over a 20% return on the money that he's lending out is freaking phenomenal, quite frankly, for a bank. Other notes. Let me just do a quick check and make sure that I've got you here. Diversification of funding is 44%. Okay. And then warehousing. Oh, yes. Final thing. 97% of the deposits are insured. And also he has additional insurance on it through the FDIC. So up to 2 million in insured, the way that they're insuring it. So there's nothing wrong with the bank. Why then is it down 12%? Okay, it's down 12% because the market's freaked out. They don't know how to interpret this JP Morgan purchase of assets of First Republic and what that implies as someone who's investing in banking in general. That's why I think give it a pause or don't. But this thing is massively undervalued. if the banks in general survive as a structure in the public format. That's your risk. Your risk isn't SoFi did something wrong. Your risk is the entire banking system is reorganized in a way that specifically causes a problem for equity investors of financial companies. That's your risk. But if SoFi has it, then everybody else has it. So that's kind of where I'm at. Thank you guys so much for joining. Let me take some questions. If you've got a question, stick it in here. Corey, great questions. Will I cover other banks in the future? The answer is yes, because I always have some interest in the banks. Here's the deal with the banks, all right? I'm not a banking analyst per se. My knowledge of the banks comes from the fact that I've just been looking at their balance sheets for so long. I officially never had a title of banking analyst as far as that goes. Okay. My background though is very heavy in risk management. So one of the things that makes it easier for me to just pick this up and read it is because, simply because, there's no jargon in it for me. And as a result, I try really hard to articulate the jargon in all of these episodes. So definitely, if I've used a piece of jargon, stick it in the comments, because that is not my intention. My intention is not to make this hard. It should make it easier. So officially, I don't cover banks, but I watch the banks. And the reason I watch the banks is because the financial system is at the heart of every single company that you could ever invest in. Whenever our financial system catches a cold, it's not that other financial systems catch an even bigger cold or COVID. If you like when our system catches a cold, the entire financial system has to take a pause, because all business depends on the ability to capitalize yourself. So I always will look at the banks. And so the answer is kind of a very long answer. Yes, so to speak. It's just whether or not I'll do more banks specifically, or whether I'll just do a general bank coverage. Okay. Second question from Corey. Do I think SoFi will offer dividends in the future to attract new customers, to attract new investors? Okay, I don't think it should, Corey, is the answer. I think what it's doing right now is the perfect strategy for where it's at, which is essentially, so you still have, even though free cash flow looks great at this company, so cash flow looks wonderful, you do still have a little bit of a loss on net income. Okay, that just is what it is, and that has to do with how these banks make money, right? So they're lending, and then they'll get a cash flow stream going forward to the extent that they hold the loans at the bank. Alternatively, they'll sell all the loans out, and so the moment that they have their costs relative to the moments that they make their money on the other side of those costs, there's a distance between it. Hence, net income can look negative even if the bank is making money. All right. Because of that, and because we still have so much uncertainty in the banking system, which hopefully will alleviate, we've got Wednesday, the Fed. I don't want them issuing dividends in this year. I really don't. Again, I have no skin in the game at this particular moment, but they're definitely on my radar screen, because that was a crazy good quarter and really demonstrates that he's turned and crested from being a startup to something way beyond a startup. And so that's kind of where I'm at with that. Hopefully that answered your question and didn't digress too much. Thank you. Occasionally I do healthcare, but honestly, I know that, some people are much better at it just because they have a significantly stronger medical background. How do I feel about Bitcoin? I like Bitcoin. This is a much longer, Brandon. I owe you one. Let me just say it that way. I want to acknowledge you. I do have some investments personally in Bitcoin, but I think it's a much longer conversation. I'll say it that way. Let's see what else. I think that's all the questions for now. Thank you so much, Pablo. That means a lot. And I, will try to cover AMC on Friday when it reports earnings. Hadouken, thanks for stopping by. Long time, no chat. Hopefully you've been living your best life, and that's why I haven't seen too much of you. And until next time, bye guys. Good luck this week.